Good afternoon, everybody. This is Bruce Ventimiglia from Saratoga Capital Management. Thank you for joining us today. We've been in business, as you know, for about 26 years now, and we're just delighted to have some of our old friends. Many of you have been with us working with our Saratoga Advantage Trust funds for that entire period of time, and some of you are new friends to us, and we welcome all of you to the call today. We're very excited to be talking to you about our Saratoga Large Capitalization Value portfolio. And in a minute, we're going to introduce you to the portfolio manager of that portfolio. But before we get started, a couple of really nice developments at Saratoga. We were recently notified by Barron's that our fund family, the Saratoga Advantage Trust, was ranked the #4 world equity manager for all fund families that they rank in 2020, on the heels of, by the way, being ranked #1 world equity manager in 2019. And as you know, Barron's looks at the 840-50 fund families out there, culls it down to about 50 to 60 that qualify. So we're just delighted that we've been able to receive that accolade from Barron's. And in addition to that, last year, Barron's ranked the Saratoga fund family the #2 fund family for taxable bond management. So we're delighted to have you join us today. As you know, when we started the business about 26 years ago, our mission was twofold. One was to bring you really great, in our view anyways, asset allocation methodologies and approaches to use in conjunction with the second mission that we had, great sub-advised mutual funds, one of which, again, you're going to hear about today. Very happy to tell you that the performance of our allocation models for the last 26 plus years has been pretty darn good. Our performance is actual performance, and none of it is back tested or hypothetical. And that actual performance for the last 26 plus years for our 5 balance models and our 5 equity models have in every single case outperformed their benchmark. So very happy to tell you about that. And the reason I introduce you to that concept is because very recently we made a change in our asset allocation modeling. And that change was to start to overweight large cap value versus large cap growth. And that was a big change for us because for the last 5.5 years prior to the change, which occurred at the end of February of this year, we were overweighting large cap growth. But we see signs in the economy and other areas of the marketplace that indicate to us that large cap value is going to start to reassert a leadership position here. And that's why we're very delighted to talk to you today about our large cap value portfolio, because it is our biggest weighting in our models right now. And we're so delighted to introduce you to the value manager that we have. It's MD Sass. MD Sass is one of the longest term investment advisors in the business. They've been in business for nearly 50 years. They're based in New York City. They manage over $6 billion. And the lead portfolio manager is going to join us in a minute, but I'd like to tip my hat to him. We have had MD Sass managing this portfolio for nearly half of the time that it's been in business, which is 26 years plus when we started the fund group. MD Sass has been on this portfolio for about 12.5 years. And you'll see, I think, in some of the comments that Ari will have today for you, that the performance is really picking up nicely. In fact, for the last 1 year ended March 31 of this year, portfolio is up nearly 80% versus the large cap value Morningstar benchmark up about 57%. And for the last 3 years, the portfolio is up nearly 15% versus the Morningstar large value category at about 10.5%. And of course, this is net of all fees. With that, I am so delighted to introduce you to Ari Sass, who is the president of MD Sass, and he's also the portfolio manager on the portfolio. Ari, welcome to the call.
Thank you so much, Bruce. Thanks for having me. Shall I kick it off?
Yes, please.
Great. Well, thanks, Bruce and John. And look, it's been a pleasure working with Saratoga for all these years. It's been a great relationship. We value it highly, and we're thankful for the opportunity to talk to you all about the Saratoga Large Cap Value strategy that we sub-advise. I think, as Bruce mentioned, the last 3 years we've put up performance that we're very proud of. And, we've made some process enhancements, I would say, right around 3 years ago, which has had a significantly positive impact on performance. And what I thought I would do is really just talk to you all about, how we're different, why we've succeeded, and why we think we can continue to do so. I apologize, I'm not on the video. I had some video difficulties, but so I'm audio only, but John graciously agreed to do the slides for me. So thank you, John. I guess if you could go to page 3, please, that would be great. And this covers a couple of key highlights about the strategy. Number one, we're concentrated, meaning we own a focused portfolio of up to 25 stocks. That started about 3 years ago. Prior to that, as a firm, we used to run more like 40 to 50 stocks. But when I became portfolio manager of this strategy, I cut the number of names in half. Why concentration? Few reasons. Number one, in our opinion, concentration actually, we think is less risky and can provide greater risk-adjusted returns than a portfolio of a lot of names. Now, that might run counter to what a lot of people say, which is concentration leads to volatility, which is risk. Look, to me, daily volatility is not risk for a long-term investor. Risk is permanent loss of capital. And how do you lose capital permanently? You do it by investing in situations that you just don't understand really, really well. You know, in our mind, in 20 names, 25 stocks, you know, we know these names better than most, and that should help mitigate blowups. Now, look, things are going to happen that we don't anticipate, right? That's part of the business. But we do think if we own our names really, really well, that should enable us to mitigate the downside and reduce the probabilities of a blowup. Second, why other reasons to be concentrated? As a portfolio manager, I view my job as having to own my own conviction in every name in the portfolio. Now, I think a lot of other value managers with 50 or 100 names, they simply can't own their own conviction in every name. They effectively have to rent their analyst's conviction. But to me, renting conviction goes really badly during times of crisis, right? During COVID, when you have names down 30, 40, 50% on you, your conviction levels run out the window if you don't have your own conviction and you're simply renting your analyst's conviction. And so for me, it's really important that I own conviction in every name, because during very difficult periods, I'll have the confidence and knowledge and conviction to actually step in and maybe even buy more when it's incredibly painful to do so. So I think owning conviction as a PM is very important. And finally, I don't view my job as an asset allocator, right? I view my job as an alpha generator. So if clients aren't comfortable owning 20 stocks, no problem, hire other managers around us, right? We don't have to be the end-all be-all. So to me, my job is an asset allocation or creating diversification. That's my client's job. And I just want to focus on the alpha generation side. Maybe I'll just talk a little bit about, and maybe, John, if you go to page 4, please. Some important differences of us versus other value managers. One was the concentration. 2, I think the style of value that we practice is quite a bit different. And what I mean by that is I think a lot of value managers, when they think about stocks, they oftentimes lead with valuation. Meaning, I've heard so many ideas and pitches from value managers that start with, I love this stock, it's so cheap at 10 times earnings, or it's so cheap at 1 times book. But valuation is not a thesis, right? It's just an observation, it's just a fact. And to me, I don't get enamored with valuation as a thesis driver. To me, what drives a thesis is having a fundamental view of a business that is out of consensus, right? Meaning my view of earnings on a go-forward basis is higher than the street, higher than consensus. Now, I want to buy that earnings stream at a reasonable valuation, right? Or even a highly attractive valuation. But that is secondary to the fundamentals of the business. And fundamentals to me matter now more than ever, because look at all the disruption going on due to digitally native companies online, right? We're seeing sectors getting massively disrupted. If you're going to lead with valuation, you're going to run into dumpster fires, potentially, right? Most stocks are cheap for a reason. So cheapness isn't so attractive to me per se. It's buying great businesses where we have an added consensus view at reasonable valuations. That to me is good value. That's very different, I think, than a lot of other value managers, and it's really helped us to outperform, I think, our peer group over the last 3 years, as Bruce mentioned. Other thoughts here. I think, and I don't want to spend too much time on this in the interest of being brief, but culture is very important. We pride ourselves on intellectual honesty, meaning it's very important in this business to admit you're wrong early. I've seen too many situations where analysts worked in an environment where they were scared to admit they were wrong or the thesis has changed. And that leads to disaster. It leads to distrust, and it leads to hope becoming the main thesis. And so the way we counteract that is creating a culture where we really encourage people to admit they're wrong. It's praised. It helps us. So that's, look, a lot of managers don't talk about culture, but I think culture is really, really important. And so I just wanted to bring that up. I'd like to turn, there's some performance numbers on pages 6 and 7. I won't regurgitate those. We encourage you to look at that when you can. I think what's interesting on page 7, though, John, if you don't mind turning there, I mentioned earlier that concentration can be less risky. Now, again, I don't define volatility as risk. I define permanent loss of capital as risk. But if you look at page 7, our upside capture, so in other words, in months where the market is up, we've captured 122% of the upside. And in markets that were down, we actually captured 90% of the downside. So I do think we've done a reasonably good job, actually, even with a concentrated portfolio, of providing good risk-adjusted returns. And look, one question we get that's very fair is, congratulations, you've had a great few years here, but why should we be excited about the portfolio going forward, right? What are we going to do next? What's our encore? I think page 9, John, if you don't mind going there, really speaks to that. And this is the characteristics of our portfolio versus the Russell 1000 value and the Russell 3000 value. And you'll notice that on earnings per share growth over the next couple of years, I'd say it's comparable, our portfolio, to the indices. Now, the indices, this is consensus I'm using for the indices, and I'm using our own estimates for our own portfolio, of course. But we have reasonably good growth here. We're looking at 20% plus earnings growth CAGR over the next couple of years, which is similar to the Russell 1000 value. But our stocks are trading much cheaper. If you look at the PE of our stocks on 2022 estimates, our stocks are trading at 14 times earnings. The market's at about 17 times. Now, this is as the end of March. So comparable growth, but better valuation. And by the way, our companies are less levered. So on a leverage adjusted basis, because typically levered companies trade at cheaper PEs. So I think our valuation relative to the market, which is more levered, looks even more compelling. So this is why we're excited about the future. We have solid growth, cheaper valuation, and stocks where our earnings estimates are materially out of consensus. I think in 2022, on average, our earnings estimates are 15% above the consensus estimates for our names. And then on page 8, if we could backtrack, here's a listing of our top 10 holdings. I won't go through any of these names now with you, but I'll note that our largest positions today are about 5%. This was actually as of February 28th. There's been some movement since then. But our top positions typically will be around that 5% level. We can go higher, but you'll normally see our top positions roughly around that 5%. And with the top 10 holdings being, approximately half the portfolio. One observation here, and then I'll turn it back over to John, is that, look, we've had great year despite being underweight the best performing sectors of the market, right? We have zero energy, which is the best performing sector. We're underweight financials, which is the second best performing sector. So look, to me, when you're running a concentrated portfolio, the sector allocations aren't that relevant. I think if you pick great stocks, regardless of the sector where you have a differentiated view, you should outperform. And I think our sector allocations, I'm agnostic to that. I will tell you we are perennially underweight, commodity-oriented sectors because I don't think we bring much of a differentiated view to commodity-sensitive sectors or names, simply because of the fact that, really having a high degree of conviction and confidence around the forward price of a commodity is incredibly difficult and too dependent on so many macro variables that I don't think we have an edge in. But otherwise, we love names and sectors that are undergoing change, because change can be misvalued, right? Change can be misinterpreted or misperceived. So we love company-specific, idiosyncratic change that we really focus on valuing and see if the market has it right. In the interest of time, I think I'll turn it back over to John, and we're happy to answer any questions.
Great. Thank you so much, Ari. I think that was a wonderful presentation. We do have a couple questions, and I will pivot to those now. And folks, there is the Q&A section of your interface there. Feel free to continue to ask any questions you might have for the next couple of minutes, and we'll try to get through them all. The first question here is maybe not something that you think about a lot, especially relative to some of what you mentioned in the beginning of the presentation about, not necessarily being an asset allocator. But the question is, how long do you expect value might outperform growth, and if that is something that you think about, Ari?
Yeah, good question. I actually don't think about it a lot because I try to think about things that are more in my control. But what I am thankful for, though, and pleased about, is we've actually outpaced the S&P even over the last 3 years, despite not having the high growth stocks, right? We don't own Amazon or Netflix, right? We don't own those high growth names that really drove the S&P. I feel like as a concentrated manager, there's always 30, 40 names in the Russell that outperform the S&P even. We should own those, right? That's our job, is to try to identify those. So with that said, and take it for what it's worth, because I don't think my macro views are worth a whole lot, but I think higher interest rates, if we are in that period, and we've seen interest rates go through very long cycles, right? We had 30 years of interest rate decline. What's going to happen with rates increase here? I do feel like that's a headwind to tech companies whose valuation is dependent upon outer year earnings growth, right? Because a lot of them have no earnings in the near term. And that should favor value. I mean, if you think about financials being, 25%, give or take, of the value index, higher rates are going to benefit financials, which dominate the value index. And clearly we're in a cyclical recovery. I can't tell you the duration of it, but the recovery, if you look at earnings this quarter, it's beating everybody's expectations handily. And so I think from a cyclical element, we have a value tailwind and potentially a secular tailwind, meaning multi-year, to the extent that rates continue to rise. I do think that favors value versus growth.
Great. Well, I appreciate you sharing some thoughts on the topic. The next question, I think, is something that we've all had on our minds for many years now, and it's something the industry faces in general. And the question is, what would you tell a client asking about the difference between your strategy and the reason to own your strategy, a very concentrated, very active strategy versus an indexed strategy?
Yeah, good question. And of course, as an industry, we face that headwind of, mix shift to passive from active, right? I think, the alpha really can be generated in an active portfolio through concentration. I think diversification or over diversification dilutes the ability to outperform. So I think concentration is almost a prerequisite for material outperformance. High tracking error, high active share, willing to make smart risk-adjusted bets and putting real capital behind it. I think is how you outperform over the long run. I think also what I had said earlier about, as a value manager, focusing on fundamentals and with valuation second is so important. That leading with valuation and hoping for the fundamentals to pull through, I think, is value trap. I think that's what's really hung up a lot of my peers. By the way, we learned this the hard way, right? It's not that we weren't born with that philosophy. It required a bit of pain ourselves to realize that. So I think those are the ingredients, right? Getting the fundamentals right more than the valuation, and concentrating to those names you have a very high degree of conviction in and a high degree of confidence that you understand the risks to avoid blowups. I think one of the interesting things is, like, for example, this year, we've had no position hurt us more than 30 basis points. Right, and last year, our worst position hurt us by 300 basis points, but that was a cruise operator during COVID, and I view that as just being unlucky, as opposed to a blow up due to some factor about the company we didn't understand. So concentration can mitigate the blow ups broadly and help outperform on the upside. I think those are the key things.
That's great. I think those are some really great thoughts. And one of the things I'd point out to the folks who are in attendance here is, many of you have come to us through our asset allocation work. And when we have overweighted value, we have seen Sass strategy outperform the benchmark significantly. So, it's one thing to outperform across all market types, but what we're really focused on is, hey, when this is what we view as a real value environment, do we have a value manager who can really hit it out of the park in that specific environment? That's really important to us because we're going to be overweight to the strategy. And so that's exactly what Sass has done, has been a great value manager in value environments. So that's really helpful to us. And the last question we have up here, in looking at the amount of time we have left, I'll just go through this one. I think it's relevant in terms of the last question as well, in the context of talking about active versus passive. Is what does your sell discipline look like? Something that passive doesn't have the advantage of is, as money comes in, there's no thought process behind whether that money is allocated or not, what to buy or what to sell. As an active manager, you have the potential benefit, the potential downfall of saying, hey, I can have a strategy specifically around when to allocate capital or not and when to sell or not.
Yeah, good question. Here's how we think about selling. I mentioned earlier valuation not being the primary driver. It's also not the primary driver of our sell discipline. In other words, we do have fair value targets for everything we own, but just because a stock hits our fair value, we don't believe that's a reason to sell, because who are we to say that a stock should trade at 17 times earnings or 18 times, right? We're not the judge and jury on that. But so why would we own something if we think it's approached our fair value? To the extent we maintain on any given position an earnings expectation that's still higher than the consensus, we're apt to hold on to the stock, even if we think it's fairly valued. Because one thing I do know is that, positive earnings revisions drive stocks, right? So if our numbers are right and we're at a consensus and the consensus needs to grind higher, that stock's likely to outperform. So the biggest driver actually to sell outright would be either one, our earnings are not different than the consensus anymore, or two, we think we were wrong, right? We think the thesis has changed, or our thesis was invalidated, or it's just not playing out fundamentally the way we had expected. That would be the other reason to sell. And I mentioned earlier culture, driving intellectual honesty leads us to cut those out early and not hold on to losers. We don't sell just because the stock goes down. We sell because we think we were wrong. The stock may have gone down in the process, though. And one other thing on that related, as a stock approaches fair value, we do trim it. So our biggest positions in the portfolio are ones where we think we have the biggest delta versus consensus and upside to fair value. Those are our favorite positions. Towards the bottom of the list will be ones that we think are reasonably valued, maybe fairly valued, but we still have a big earnings delta versus the street.
Great, thank you, Ari. It's Bruce Ventimiglia joining again. Let me thank John and Ari for a wonderful presentation. A couple of closing comments, if I may. You can find much more information regarding the Saratoga Large Cap Value Fund that Ari is managing with his team at saratogacap.com, which is our website address. And just go to our mutual fund section, and then you'll see the large cap value icon. Click on that and you'll find a lot more information about the fund, including more performance for longer periods of time. In addition, for those of you who'd like to see our thoughts on why we're overweighting large value today over large growth, please go to the asset allocation section of our website. You'll see a good deal of our proprietary research there, which will give you a good indication of why we've shifted over to large value over large growth. And you'll also see a bunch of different statistics about the economy, how they've been moving and how they're shaping up. And as another quick closing comment, if I may, looking at markets just in general, as we get higher and higher, more frothy, if you will, in market environments like perhaps we're getting now, we're at a very, very wonderful level, if you will, at 34,000 in the market. Looking at active versus passive, to me and to Saratoga, it becomes much more important to be active as the markets get higher and higher and higher and frothier and frothier and frothier. Because as you know, as markets go up, most stocks will go up, including stocks that perhaps don't deserve to go up because that rising tide lifts all boats. So this is a time, in our view anyways, when you absolutely, if you have a choice, want to use active management that can try to work through what should really be going up in their view, in this case, MD Sass and Ari, and what should be left behind. An index doesn't have that advantage. An index just has to keep allocating proportionately to every single security in the index, whether it deserves to get more money or it doesn't deserve to get more money. So this is one of those real important junctures in Saratoga's view where active management is a very important ingredient to hopefully future investment success. And with that, again, we can't thank you enough for joining us and for being part of the Saratoga family for many, many years. And if you have further questions, please feel free to just send an email over to us. You can send an email to us at saratogacap.com, and we'll respond to it. We'll get Ari's team to answer questions that are specific to Ari as well. Again, thank you very much for joining us. Hope you have a wonderful rest of the day. Thank you. Bye-bye.